What's up, guys? It's Brad with The Bottom Line. Today I want to break down a beginner's concept in stock valuation, and that is the PE ratio. Basically, this ratio will tell you if a stock is trading at relatively cheap or expensive levels. In other words, it gives the value of a company relative to how much money it makes or its earnings per share. So you might also hear the phrase trading at 20 times earnings, and what that means is you would be paying a multiple of 20 for what that company made in the past year. So if you could put two and two together, the price to earnings ratio is just the price divided by the earnings. So for example, say stock XYZ is trading at $100 per share today, and the past year's earnings per share was $5, we would take the $100 price per share and divide it by the $5 EPS, and that would give us a PE ratio of 20 for stock XYZ. So what is a good PE ratio? Well, technically there's no such thing as a good PE ratio. In general, a low PE is better because it signals that a stock is cheap and undervalued, and a high PE is generally not so good because it signals a stock is overvalued and trading at expensive levels. However, this is not always the case. A company may have a high PE because it is showing very strong growth and has high future projected EPS numbers. And a company at a low PE may be at a low PE for a reason. It may be performing very poorly or in a dying industry, so don't just go and buy a company because its PE is really low. One thing to consider, for example, years and years back, Apple traded at what seemed at the time a very high PE. However, Apple obviously blew numbers out of the water year after year, and looking back, that PE was actually relatively cheap considering what Apple went on to do. Another thing to note, PE ratios are most useful on a relative basis. So what I mean by this is if you're looking at a tech company, for example, you're going to want to compare the PE ratio for that company to its peers in the tech industry. So if you were looking at Facebook, compare its PE to, say, Google or Twitter, companies like that, because they are in the same industry and have the same kind of growth potential. Types of PEs. One is the trailing 12 months PE, or the TTM PE, and this will place an emphasis on historical performance, and you would just add the past 4 quarters EPS numbers for your calculation. Now the forward PE, this is probably one of the best to use for valuation because it places emphasis on the future. So you would just add the future estimates for the next 4 quarters for EPS. And then there is the blended forward PE, which is kind of cool because you can, depending on how much weight you want to give to the past or the future, use EPS numbers from the past quarters and the future estimates. So if you wanted to weight the past heavily, you could do the past 3 quarters and 1 future estimate, or 2 and 2, or 1 past quarter and 3 future estimates. So guys, the bottom line, the PE ratio is one method to measure valuation, and it gives you the multiple of what you are paying for a company's earnings. However, make sure you're using this on a relative basis to the industry or market peers, and make sure you never just use the PE ratio as a sole measure of valuation. Pair it with other metrics and research on that company and why it has a good growth story. Guys, if you enjoyed the video, please comment below and smash that like and subscribe button. Thanks for tuning in, and I will catch you in the next video.